Live from Washington, D.C., this is Balance of Power with Joe Matthew and Kailey Leinz.
President Trump says the U.S. is waging economic warfare against Iran, while the Treasury Secretary is waging a war of his own against higher long-term rates. Welcome to Balance of Power on Bloomberg TV and radio. I'm Kailey Leinz here in Washington, where the Treasury Secretary, Scott Bessent, says he will hold a press conference on Monday on the economic levers the U.S. is getting ready to pull to bring Tehran to heel, as he also suggests that the bigger buybacks the Treasury announced just yesterday could be even bigger than what was initially described. We'll have the latest with Bloomberg's Tyler Kendall, as well as analysis from Anna Ashton of Ashton Analytics and our political panel this hour. Plus, you'll hear an important conversation that Tyler had earlier today with the chair of the CFTC, Michael Selig. It's all ahead, but first, we have to begin with the markets and the bond markets that perhaps aren't doing exactly what Scott Bessent would like to see them do today. And for that, we turn to Matt Piper up in New York. Hey, Matt.
Hey, Kailey, thank you so much. Live from the Bloomberg Interactive Broker Studio, I'm Matt Piper. Bond yields still on the upswing, erasing most of the pullback they saw the previous day after the Treasury Department announced an intervention aimed at easing pressure on longer-dated government debt. We check the markets for you all day long here at Bloomberg. Right now, the Dow is down 409 points, or about 0.8%. The S&P is down by 25 points. The NASDAQ is down by 173. The yield on the 30-year Treasury bond, which is the primary focus of this accelerated buyback, right now is up 5 basis points. The 2-year yield is up 2 basis points. The 10-year, the main benchmark for mortgages, car loans, and credit card debt, is up at 5 basis points, just like the 30-year. The dollar is little changed. Bitcoin is trading above $70,000 for the first time since June. Bitcoin right now at $72,700. Gold is up at 23%, or 4,568. Oil is moving higher. Brent crude at $93 a barrel. WTI at $87 a barrel. Stocks we are watching: Moderna, mRNA on the Bloomberg terminal. Shares are pulling back following yesterday's 177% rally. That was the biggest in the S&P in the past 25 years. That happened following highly successful phase 3 trial results for its experimental mRNA-based personalized cancer vaccine. Today, a different story. Moderna shares are down 44%. Walmart, they're all about rollbacks in stores. Today, a rollback in its stock. This after it saw its slowest U.S. sales growth in 6 years. Its quarterly shares hit 2.6% in the second quarter, less than what was expected. Despite that, Walmart raised its full-year guidance for sales and adjusted operating income. Walmart shares right now are down 10%. And a Starbucks shred. The coffee giant has just eliminated 104 roles as part of a restructuring meant to boost growth, laying off workers who declined to relocate to its new Nashville office from Seattle. They like that Pacific Standard Time too much. Starbucks shares right now are down 1.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Matt Piper. That's a Bloomberg Business Flash. Now back to Balance of Power with Kailey Leinz.
All right, Matt Piper, thank you so much. So much to watch in financial markets today, in the bond market and the equity market. Pretty incredible to see this move on Walmart that Matt was just talking about. The worst day for that stock going back to February of 2024. It's at the lowest level since November of last year on the back of that weaker than expected print. And of course, in large part, that is due to the drug price negotiations that the administration has been engaged in, but still could very well send a signal about the health of the U.S. consumer and the economy overall, which, of course, President Trump repeatedly contends is hot and is doing great. At the same time, he also has repeatedly said that Iran's economy is suffering, pointing to higher inflation rates and a weaker currency, due in large part to the U.S. naval blockade that it is still maintaining in the Strait of Hormuz. The strait, of course, which the president says is still entirely in U.S. control, as he said at the White House just yesterday.
We can't let Iran have a nuclear weapon. We have possession, complete control of the strait. We've had a lot of oil coming out, a lot of oil. It's not going to be perfect, but it's a lot of oil coming out.
And the president's getting ready to go even further than just the blockade, if you take him at face value, and what he posted on Truth Social, announcing perhaps what he described as an economic D-Day against Iran, writing, quote, "No one has given the Islamic Republic of Iran a greater opportunity to make a deal than me. Tragically for them, they have failed to take it. Therefore, today, I am announcing the most crushing economic operation ever taken against any country." So what exactly will that look like? Maybe Tyler Kendall knows, our Washington correspondent who is here with me in the D.C. studio. So, Tyler, the most crushing economic operation ever taken. That operation would entail...
Well, we're waiting for that answer, of course, not to, not make good on all that anticipation that you led me with. But we'll have to see. On Monday, we very likely will get some firmer details. The U.S. Treasury Secretary Scott Bessent did announce that he will hold a press conference focused on what this could entail. President Trump did give us a few clues, if you will, in that Truth Social post. People are picking up on the fact that he says that this will be geared toward other countries, those that he says allow their financial institutions to supply any sort of lifeline to Iran. He outlined that that includes cash transfers, swap lines, ship registries, or any avenues to smuggle its oil out. And that is what everyone's picking up on. Adding in part, quote, "You know who you are." That is raising questions on whether or not that means the U.S. is going to more strongly target Chinese purchases of Iranian crude, though that in and of itself has a risk to the Beijing-Washington truce about a month away from the Chinese President Xi Jinping coming here to D.C. There's a few other things that we're tracking that are sort of on our list of potential ways that the U.S. may exert economic pressure, some more targeted actions against the so-called shadow fleet that actually moves the oil for Iran. We could also see the U.S. move to try to seize frozen Iranian assets that are within their jurisdiction, though I was speaking with one analyst who says this may be a little easier said than done because even if it's in the U.S. jurisdiction, you have to get third-party countries involved. But it's definitely something to watch against the background that the president has already threatened so-called secondary tariffs, 25% on any country that does business with Iran. Whether or not he follows through on that remains to be seen.
Okay, so we're going to have to wait to see and hear detail, I guess, from the Treasury Secretary on Monday. In the meantime, Tyler, we're hearing from the Treasury Secretary about a separate issue today. Once again, he's trying to talk down long-end rates, it seems, suggesting that the Treasury could be buying back even more long-term debt than it announced yesterday, which was larger than what it announced 2 weeks ago. He essentially says he's trying to bring the market back to equilibrium. He told reporters this at the White House earlier.
Anything that happens within a 24-hour period is noise. And, I think that once the market understands that we are focusing on fiscal consolidation and that we are trying to bring the market back into equilibrium in a thinly traded market, I think, I'm confident that bonds will continue declining.
And Tyler, you were at the White House yesterday when the president was asked if Americans should be concerned about volatility in the bond market. His answer was no. And yet the Treasury Secretary seems to be suggesting he's a little concerned.
Yeah, and willing to take additional action, as well as saying that the administration will be unveiling a new fiscal initiative to address borrowing costs. Of course, this is becoming a politically fraught issue here in Washington as financing costs make their way through to the broader economy. This month, we're seeing that mortgage rates hit their highest level since July of 2025. I picked up on this quote from the Treasury Secretary. He said, "All we're trying to do is get people to focus on the fundamentals and not trade the headlines." He didn't specify what the new fiscal push would involve, nor what headlines he was referring to. But yesterday we got one in terms of the debt load reaching $40 trillion. And if we dig into some of that Treasury Department data, that includes a record July budget deficit fueled in part by a surge in Medicare costs and Social Security, as well as the interest that we pay on that debt. But I don't need to tell you that it is politically difficult right now in Washington to cut spending, especially during an election year.
Well, of course, Scott Bessent has blamed this in part for the fact that a lot of the tariff revenue they were counting on isn't coming in because of the Supreme Court decision and refunds that have to be issued. On tariffs, just quickly, are we about to get more tariff revenue from Canada or not, Tyler?
Well, the USTR Jamieson Greer is meeting right now with his Canadian counterpart. I don't have my terminal in front of me. I'm not sure if we're getting headlines on it quite yet, but we're waiting for this finalized deal. Maybe something is in the works. We have reporting, Kailey, it looks like that we are going to see lower tariffs when it comes to autos, maybe 25% to 15%, and metal tariffs potentially cut in half. But that could maybe open the door for a little bit more trade access between the two economies, according to this White House. But we still need to see those finalized details on paper.
We're waiting for details on a lot of things. Tyler Kendall, thank you so much, our Washington correspondent, here with me in the D.C. studio. And I want to return to what Tyler was talking about, the countries that apparently know who they are, that the U.S. may be looking to as it tries to tighten the economic screws against Iran. China, of course, the first one that comes to mind, at least for me, and perhaps so as well for Anna Ashton, who, of course, is the founder of Ashton Analytics and a former China analyst at the Department of Defense. She's here with us now on Bloomberg TV and radio. Anna, welcome back to the program. It's good to have you. China has responded to what President Trump announced, suggesting that it does not believe that pressure and economic sanctions are going to work, that diplomacy is what has to be pursued here. Is that China basically telling the president we're not playing along with this effort?
More or less, yes. I think, that the White House is probably trying to ratchet up pressure, not just on Iran, but a little bit on China ahead of the September visit of Xi Jinping. It's been sort of de rigueur for Trump to ratchet up pressure ahead of major talks. But behind the scenes, we have to assume that Xi is pretty committed to reaching some sort of agreement, getting something done during this visit, and that Trump is too. So, how much of this is theater is I think, the most important question.
Well, on the subject of that visit, I actually discussed this on Balance of Power earlier this week with the former National Security Advisor to President Biden, Jake Sullivan. I asked him specifically who has the stronger hand, frankly, in that meeting that's coming up in just a few short weeks. This was his answer, Anna.
One of the biggest things America has historically brought to the table in the competition with China is a network of powerful, robust alliances in both the Atlantic and the Pacific. And China has had a long-term strategy of wanting to undermine those alliances, to weaken them, to divide the United States from its allies. And they're looking right now and saying, wait, President Trump is actually doing our work for us. And I think it does mean that President Xi will come with a certain swagger in his step, because he believes that they are making progress economically and technologically, they are making inroads diplomatically, and the United States is losing or is degrading one of the most critical assets that it has.
I wonder if you agree with that characterization, Anna.
I couldn't agree more. The reality is that not only is China looking at a United States that has weakened its relationships with its allies, but on top of that, China is looking at a United States that has depleted a significant percentage of its weapon stockpiles, that is trying to both announce that it is going to become more reliant on itself in things like AI and drones, and then at the same time needs critical resources from China still, and for the foreseeable future will still need those critical resources from China in order to be able to compete. There is definitely a change in terms of who seems to have the upper hand. And at present, I think Xi Jinping likely feels like he does.
Well, and as you talk about some of those critical materials that the U.S. needs to power a lot of things, the defense sector included, how quickly, if the U.S. were to actually do what the president is suggesting and punish those who are still going to purchase Iranian crude and not abide with a tighter economic chokehold that the U.S. wants to get on Iran, if President Trump were actually to say, okay, then China, here are higher tariffs that you have to deal with, how quickly does that spiral into, say, fresh export controls of critical minerals and rare earths?
I think that that's exactly the right question. I think, too, that is the lever to look at. How quickly China pulls that lever, I don't think it would be, a significant ratcheting up of export controls immediately, unless what the United States did was explicitly targeting China and hit really hard in terms of punishing China's ability to compete internationally because it couldn't receive oil from Iran anymore. But that's a really hard thing for the United States to do. I mean, the reality is that China is actually quite diversified in terms of where it gets its oil and gas. And although it is dependent on the Strait of Hormuz, like so many other countries, it has plenty of fallback options. So I don't think that that's the lever that the White House thinks it is.
Well, and on oil specifically, I've been told many times throughout the course of this conflict and the difficulties in the Strait of Hormuz that in large part why oil prices haven't moved higher is because of China, because they've pulled back as a buyer on the global markets and have been leaning on their massive oil stockpiles. How easy would it be for China to decide also to pressure the global oil market to drive prices higher by coming out and buying in force again?
That's an interesting question, and I can't honestly answer that one. But I think that it is worth exploring.
Well, let's go to another area then that is definitely top of mind when it comes to China. I hope you can weigh in on artificial intelligence. We are having a massive conversation here in the United States around data centers, the infrastructure that powers AI. The industry, of course, will tell you we have to have these data centers. We have to allow these models to advance because if not, we cede ground to China. Obviously, their domestic pressures in communities and concern over water and energy prices, utility bills would suggest a pullback. Is there merit to the argument that China is within a breath of being able to surpass us on artificial intelligence if we slow down even slightly?
I do think that there's merit to the argument that China is catching up fast. And one of the reasons it's catching up is because it has a very different ecosystem in terms of its energy resources and its ability to bring these huge data centers online. That's cheaper and easier for them than it is for us. And so that is one way that they're going to continue likely to outcompete us. However, in terms of what their AI capabilities are, the experts seem pretty firm on their conviction that China's not actually within a breath of catching up to us. I guess we'll have to see.
Well, and how much of that is dictated by the controls that the U.S. has put in place, the export controls around chips that power this critical technology? A headline crossed the Bloomberg terminal just a few minutes ago, Anna, from the information that NVIDIA is plotting a new chip for Chinese customers that perhaps, I guess, would get around some of those export restrictions. We haven't confirmed that here at Bloomberg, but apparently this chip would be compliant with the export control rules. Does that suggest that the export controls are working or that there's so many loopholes at which China is still able to access that they aren't as effective?
I think the export controls have been working to slow China down because, it is much harder to achieve the goals that they want to achieve in terms of AI capabilities without those chips, and they don't have them yet. But, the export controls have also guaranteed that China is pouring more and more and more resources into developing them and is determined to be less and less reliant on sources like NVIDIA for those chips. It's great for them in the near term if they can buy some NVIDIA chips, but in the long term, what they want is to not need them. And they're working hard to do that.
Anna, we have less than a minute left here, but how do you think China is viewing and interpreting the president's rhetoric in the last few days around the Korean Peninsula, attacking South Korea, talking about a good relationship with North Korea? Does drawing back on joint military exercises with South Korea also send a signal to Beijing?
Certainly does. And I'm sure it's a positive signal from Beijing's standpoint. And we also, have been pulling our aircraft carriers out of the region. And we just are giving numerous signals that we're sort of abandoning the Pacific as an area of primary focus.
All right, Anna Ashton, great to have you back on the program, joining us from Ashton Analytics. Thanks so much. And indeed, we have seen the carrier, the George Washington, leave the Pacific. It's now in the Middle East to relieve the Lincoln. We'll have more ahead here on Balance of Power on Bloomberg TV and radio.
It's 1:21 on Wall Street, live from Bloomberg Interactive Brokers Studios. I'm Matt Piper. Treasury Secretary Scott Bessent's bold intervention to stem a potentially damaging rise in U.S. borrowing costs has some investors saying the dollar will ultimately pay the price and could push investors toward alternatives. To the big board we go. Everything is still down at this hour. The Dow is down nearly 500 points. The S&P is down 39. The NASDAQ is down 235. Oil is moving higher following following President Trump's latest threats to Iran. Brent is at $93 a barrel, WTI up about 2% at $87.79. This is a bad dive. Alibaba, BABA on the Bloomberg terminal. Alibaba's profit diving 75% after AI spending hit $10 billion for the company. It reported a 9% jump in revenue, but net income did tumble. Alibaba expects annualized revenue from AI products to near $10 billion this quarter. Alibaba shares right now not doing as bad as earlier in the day. They are still down, though, about 0.3%. SpaceX shares are also down. They're down by about 9% as a second tranche of stock is released from a post-initial public offering lockup period. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Matt Piper, and that's a Bloomberg Business Flash. Kailey.
All right, Matt Piper, thank you so much. Matt pointing us, of course, to the bond market. Well, yields at the long end are on the climb back up today, erasing a lot of the gains we saw yesterday off the back of the Treasury's larger buyback announcement for the long end. And the Treasury Secretary, Scott Bessent, of course, today went even further to say that that could be even larger than $4 billion per issue. And yet we're still climbing 5 basis points on the 30-year, which is sitting just around 5.25% as we speak. The issue here may be that the market is clinging to the illness, like inflation and the debt, which, of course, as we told you yesterday, has crossed $40 trillion, doubling in just the last 10 years. The Treasury may instead be trying to address the symptom, which means it could be a near-term fix, but not a long-term one, as I heard yesterday on Balance of Power from Jason Furman, the former chair of the Council of Economic Advisors under President Obama.
There's two solutions. You can cut spending, or you can raise taxes, or you could do some combination of the two of those. There's two things pushing up inflation. One is the pushing up interest rates. One is expected inflation. Now, the good news here is the market seems to believe, and I agree with the market, that the Fed is going to keep inflation under control, but they're going to keep it under control by raising interest rates. And second is just the general upward pressure that comes every time there's a voracious demand for capital. And that's what we have right now. And I just don't think any of those are going to change, short of a recession or a bubble bursting or some bad event like that. Higher interest rates, to me, are likely here to stay.
But of course, higher interest rates are exactly what President Trump doesn't want, as he said again repeatedly at the White House yesterday that he thinks rates should go down because the economy is strong, not up. But if the things that might bring interest rates down are raising taxes or cutting spending, as Jason Furman told us, there's a real question as to whether or not Washington is ready to deliver on either of those things. And it's on that note we turn now to today's political panel. Rick Davis is with us, Bloomberg Politics contributor, Stonecourt Capital partner, and Republican strategist, alongside Democratic strategist Caitlin Legacki, senior fellow at Third Way. Welcome to you both. Rick, higher taxes or cutting spending, which one of those is politically appetizing?
Well, I think if the American public starts realizing that the amount of debt that is represented in this $40 trillion number represents $120,000 per American, they start to get a little edgy about that. And we haven't gotten to that point. It hasn't become a real salient political issue at this stage, but we've seen it when it has, and things change. And so you do see Congress in the past, when they've had pressure from constituents to make changes to the amount of spending they have, they impose all kinds of different measures to stop spending. They rarely actually cut back on the actual spending. And so I don't think you can be very optimistic that either taxes are going up or spending is going to come down. But I could see in the very near future, certainly by the 2028 cycle, a real effort to start reining back on the growth in spending, which would send a good message to the market. But the idea that taxes go up and spending goes down, very optimistic and probably unrealistic.
Well, so let's talk about where you could see cuts in spending. This administration, at least, doesn't want to see them come in one of the easiest discretionary areas, perhaps, or the largest that you could target: defense. They want a bigger defense budget. You still have to pay interest on the debt, Caitlin, so that leaves the non-defense discretionary areas, which aren't really enough to make a dent. And then it leaves the mandatory spending and entitlements. Is there going to be any candidate maybe not in this cycle, but in 2028, who's going to talk seriously about reforms to Social Security or to Medicaid?
I don't think they'll be focused on Social Security or Medicaid, but I do think that you raise an important question, which is, as we are going into a presidential primary, we're going to have a lot of candidates throwing out big ticket spending ideas. And I do think that we have to be very serious about addressing how we plan to pay for those ideas, how we plan to pay for those programs, and then also ensure that we're delivering those services effectively. I think we saw from the Doge episode that Americans agree with the idea of cutting waste, fraud, and abuse, but we also saw that it's really, really hard to do that without hurting people. And so that's going to be an important balance for any candidates to strike. And unfortunately, I don't have the highest degree of confidence that they're going to focus on that.
Well, what about when it comes to the revenue side, to the idea of raising taxes? Because there are plenty of people on the left, Caitlin, who are floating ideas around taxing the rich. You see the wealth tax that's on the ballot in California in this cycle. If Democrats do get power back in Washington, is that realistically what should be expected?
I think that there's going to be a lot of conversation about it, but I have a hard time seeing the rubber meeting the road and it actually getting done in a comprehensive way, just because the kind of majority it's going to take to pass that kind of revenue raiser is the kind of majority that's built on a lot of red and purple districts and seats. And those candidates are not going to want to go into a midterm election talking about how they raise taxes. And I think that's part of why this is so hard, because we do need to start raising revenue again. And we do need to simplify and make our tax code fairer. And it's hard to do that without actually generating more revenue and ensuring that, billionaires and corporations are paying their fair share.
Well, yeah, so a lot of this is hard, I think, is the lesson we're learning from you both. And Rick, if there are no easy answers, the Treasury Secretary at least is searching for some that he can use in the immediate term, with things like buybacks, trying to talk down the long end of the bond market. I wonder what you make of the Treasury Secretary, this administration, frankly, because we have seen this from President Trump as well. Remember, he pulled back on the initial tariffs from Liberation Day in April because he said the bond market was getting yippy. It seems that the Treasury Secretary is also worried about the bond market getting yippy here. What is with this administration and taking cues from fixed income specifically?
Yeah, look, when the president came in, everybody was talking about how non-interventionist they're going to be. They really thought that these were the policies that they could pursue. And I think, right now, Secretary Bessent may go down in history as the most interventionist Treasury Secretary of our time. And that's saying a lot considering what we've seen in the markets over the last 25 years. So I'm really stunned by the approach. They don't seem to be willing to bite the bullet and to try and do the hard stuff. Look, this administration is at the end of its next 2 years, right? They'll never run for re-election. They have an opportunity to actually get the fiscal house in order without paying a political price. And it's amazing to me that the only resolution they have right now in this bond crisis is to just, continue to buy long-term debt. That has a limit to it. And I'm not sure how effective that is in curbing inflation, in helping to spur growth. If anything, it has the opposite effect. So I think this administration's got themselves in a bit of a pickle. I would disagree that doing things like reforming Social Security and Medicare and talking about things like a flat tax are politically dangerous. I've seen candidates do very well when they talk straight talk to the American public and say, Social Security is not sustainable past 2030. We have to do something to fix it. And in the process of fixing it, maybe we can reduce the debt that the American public has. And people like the idea of a flatter, simpler tax cut. And by the way, there are a lot of billionaires who would pay a lot more in tax if everyone got on a flat tax.
Well, that is certainly a point well made, Rick, as we consider the amount of wealth that is percolating out there in this K-shaped economy that we are dealing with here in the United States. Caitlin, just on the point that Rick was making about how interventionist this Treasury Secretary in particular has been, knowing how much he criticized his predecessor, Janet Yellen, for frankly similar behavior when it comes to the different maturities that the Treasury is issuing as it tries to obviously fund all of this spending that we've been talking about. What does that say about, is it about this administration or just a changing nature of the role of the Treasury in financial markets that has now been forever reset, perhaps?
Well, only Nixon could go to China, and I think only Trump could intervene in the markets the way that he has. But it is setting a new standard and a new set of norms that, 3 years ago were simply not conceivable. And, when you look at the way they've, taken stakes and equity and in private companies, the way they've influenced the private sector, and it is unheard of. And I think the risk now for the private sector is Democrats are going to see this and they're going to want to do it also. And so this is a little bit of a Pandora's box that has been opened, and I think we'll have to see how it plays out long term.
And before I let both of you go, I also want to ask you about the president's promised economic D-Day against Iran. Caitlin, we are awaiting the details here, but it seems like what this actually is the U.S. asking a lot of other countries to play along with it in trying to tighten the economic screws. Is the Trump administration likely to get that?
It's hard to say, but I think the bigger issue is that this should have been the first step before they started launching bombs. And what we have seen in the past and what we've seen historically is that this kind of economic sanctions is usually a good way to avoid unnecessary wars. And because we're doing things a little bit backwards, I think it remains to be seen whether that's actually going to be effective.
And Rick, in our final minute here, is economic D-Day really going to be a D-Day?
Yeah, we've been hearing economic D-Day for a long time. We've had sanctions on this country for 50 years. And I'd like to hope that they would actually be more effective today than they have been, but you can't hold your breath on that. The reality is we're not putting pressure on Russia. We're not putting pressure on China. And now we're making friends with the North Koreans, all of whom are supporting the Iran war for Iran. And so until we actually get straight with who our friends are and who our enemies are, I can't imagine economic D-Day is going to have the impact that the real D-Day did.
All right, we'll leave it on that note. Rick Davis and Caitlin Legacki, great stuff, guys. Thank you for joining us on Balance of Power. And we still have more coming up ahead on the program. An important conversation between Bloomberg's Tyler Kendall and the chair of the CFTC, Michael Selig, as we consider the fate of the Clarity Act when Congress returns from recess. That's just ahead here on Bloomberg TV and radio.
It is 1:40 on Wall Street, live from the Bloomberg Interactive Brokers Studio. I'm Matt Piper. Treasury Secretary Scott Bessent says the administration will unveil a new fiscal initiative to address the highest borrowing costs in years. It all has stocks not doing so hot. We do check the markets for you all day long here at Bloomberg. The Dow is now down more than 1%. Down 540 points. The S&P is down 44 points. The NASDAQ is down 246. The Bloomberg Dollar Spot Index is at 1193. The 2-year yield is at up 2 basis points. The 10-year yield is up nearly 6 basis points. The 30-year, we don't always talk about that one, but it is the primary focus of the accelerated buyback. That is up 5 basis points as well. Bitcoin up at its highest price all summer, above 72,000. Crude oil is moving higher. Brent is at $93 a barrel. WTI at 88 bucks. As for stocks we're watching, Deere shares are jumping after the company says it's seeing a boost in orders for its machinery, raising hopes that the agriculture sector is poised for recovery. Deere shares right now up 43%. Let's talk travel and look at airlines. Southwest Airlines stock has climbed about 40% in recent months. Now, that could be due to the demise of rival budgeter Spirit. The air industry overall, though, is down thanks to rising labor costs and concerns about aircraft delivery delays. Southwest Airlines right now is down 1.1%. Delta is down 2%. American not doing so badly compared to the rest. That's just down 0.3%. United is down nearly 4%. Speaking of travel, the hottest travel souvenir, not that magnet for your fridge. It's learning something new. Some are treating time off like an investment, using their vacation to learn a skill from surfing to cooking. According to a survey from MasterCard, 48% of us are planning a trip this year specifically to learn something. However, these skillcations, as they're called, can cost more than a normal trip, depending on the destination and, of course, the type of activity. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Matt Piper. That's a Bloomberg Business Flash. Kailey.
All right, Matt Piper, thank you so much. I personally never really want to use my brain on vacation. The whole point of vacation is checking
no
out
skydiving, right?
For me. But, more power to you if you want to use your free time to expand your brain and your horizons. Matt, appreciate it as always. Speaking of expanding horizons, James Braid is expanding his horizons to the private sector. He's getting set to depart the White House in September, according to President Trump. James Braid, of course, is the White House Director of Legislative Affairs. And the president credited him in his post announcing his departure on True Social with many of the big accomplishments Congress has made during Trump's second term, including the One Big Beautiful Bill, beating the Democrats in 2 shutdown showdowns, the president says, and passing the Genius Act, as well as a number of other things. The Genius Act, of course, was the stablecoin legislation that did get across the finish line. It was part one of what Congress wants to accomplish when it comes to crypto lawmaking. Part 2 is the Clarity Act, which may have to find its way through the United States Senate without the help of James Braid, unless someone is quickly put in his place to try to get it across the finish line. The Clarity Act, of course, is the market structure legislation, divvying up which digital assets should be regulated by which regulatory agency, the SEC or the CFTC. It gives a lot of jurisdiction to the CFTC, which today is holding its inaugural Innovation Advisory Committee meeting. It kicked off yesterday at the White House. The president actually greeted not just the CFTC chair and SEC chair, but heads of the major exchanges as well as the big crypto companies, got them all together and called on Congress to pass the Clarity Act. And we'll see whether or not that happens after recess. The question, of course, if it doesn't, is where it leaves things. If there's no firm rules of the road written into the law when it comes to crypto, is it all just up to the regulators? That's where Bloomberg's Tyler Kendall began her conversation with the CFTC chair, Michael Selig, and they got into a number of other subjects as well. Let's listen to their conversation in full.
We're very optimistic that we're going to get clear rules of the road for crypto asset market structure on the books, and this vote is critical. We've got to get the Democrats to come along with us. They have really obstructed. We want their support. This should be bipartisan. The bill passed the House in a bipartisan fashion. We've got this bill in the Senate. It's very similar. We want to get it across the line. It needs to be a fair bill, a bill that isn't targeting the president or anybody else. It should be neutral and apply to everybody in the same way. We're really excited to get this bill across the line. CFTC stands ready to implement upon the passage of the bill.
Just to quickly follow up on that, was there any discussion yesterday about any updated ethics provisions related to the bill?
Well, the ethics provision is under negotiation. We're looking forward to seeing a fair ethics provision that's not targeting the president or anybody else, as I said.
If Clarity stalls or fails to pass, the CFTC has signaled that it's prepared to unilaterally dial up oversight. What would that look like? What sort of rulemaking are you prepared to take in that scenario?
The CFTC has a lot of authority, and we're not afraid to use that authority. The president has promised market structure for the crypto industry, and that's what we're going to do, whether we have a bill or not. But we're optimistic the bill is going to set the standard. We really want the United States to lead, and having legislation, clear law on the books is the most surefire way to lock in crypto market structure, and so that's what we're focused on today.
But for my clarity, if Clarity doesn't pass, you're still going to pursue regulation related to this?
Well, absolutely. It's really important that we have market structure. We can do that through rules. We can do that through laws. The CFTC has a lot of authority under its existing statutes, as do other agencies. And if we have to utilize that authority to create rules without the supporting legislation, we'll do it. But of course, legislation is the priority. That's what we want to see. America needs clear rules on the books. We'll use rules if we have to, but we're going to focus on the law today.
Right, because in theory, or not in theory, in reality, the Clarity Act is there to codify this into law. So I'm just wondering how you're thinking about the future here to ensure that if there's a Democratic CFTC under a different administration, it wouldn't unwind all the work that you'd be doing.
We're, of course, going to look to the bipartisan efforts on the Hill no matter what. If we have legislation, we'll implement that legislation. If we don't have legislation, we'll, of course, utilize that existing work that's been developed on the Hill and utilize our existing authorities and do what we can to set rules of the road for crypto. But the bill is really the priority. The bill has to get passed.
Last question on this, just to try to get a little bit more information. Is there a timeline that you're looking at where you would act? Are you already preparing any of this action, or does it have to happen once we see ultimately the fate of that bill?
I've asked the staff to explore and evaluate potential rulemakings utilizing our existing authority, but we're focused on the bill today. Until we get that across the line, until we have an answer on where the bill is going, we're not going to propose any new rules.
Okay, fair enough. I have to ask you about the other side of this remit as well, of course, prediction markets. This might be the first election where the public at large seems hyper aware of prediction markets. How are you thinking about policing against insider trading when it comes to political event contracts? And in particular, should we expect the CFTC to release any specific guidance ahead of the midterms?
Absolutely. We're utilizing all of our authorities to police these markets. They are derivatives markets within our exclusive jurisdiction. We take that responsibility very seriously. There's two things that we're looking for. One is insider trading, as you mentioned. The other is just fraud and manipulation. We saw a number of cases, some of them have become public, others we're still investigating, where there's just fraud, right? Somebody makes a statement and then takes a position on the other side. That, of course, is not legal within our framework, but there's also insider trading where people are misappropriating non-public material information that they obtain, whether it's from their employer, from their client, whatever, right? They take that information and they trade on it. That's insider trading. It's no different if it's a security, a commodities contract, or an event contract. And so we take that responsibility very seriously.
But any firm guidance from your agency ahead of Election Day?
We've put out a number of advisories and reports and that sort of thing. We've settled a handful of actions. We'll continue to do so. In terms of our enforcement advisories, we believe that the rules are very clear, our statute's very clear. There isn't really any needed guidance necessarily on insider trading or manipulation. We may put out further advisories, but we're focused on building the policy side, the rulemaking, and then policing these through actual investigations and bringing actions against bad actors.
Just since you did bring up investigations very quickly, can I ask you, related to news of the day, the markets are watching any sort of update when it comes to the conflict in Iran. Can you give us any update on your investigation into those suspiciously timed trades linked to the war?
I can't talk to any investigations. I appreciate the effort there, but no, can't speak to that.
All right, let's think broadly about legal strategy and the CFTC. We saw this federal judge the other week rule against you in Wisconsin when it comes to sport events contracts, letting state regulators move forward in terms of classifying them as gambling. Can you just talk to me a little bit more about your strategy and how the agency plans to sustain this exclusive jurisdictional argument if you keep getting these mixed rulings from the lower courts?
We haven't lost in a single federal appellate court. We don't intend to. If we do, that's going to create a split, and we'll see it at the Supreme Court. That's our focus. We want this to be clear, codified law in the books, and we'll take it all the way up to the Supreme Court.
So if it goes to the Supreme Court, though, and the judge rules that sport contracts are gambling, how will that impact the CFTC and these companies that you regulate?
To the extent the Supreme Court were to rule against us, of course, we'll follow the law.
All right. I wanted to ask you about the agency's June 2026 proposed rule, which does put some of these guardrails in place. Do you think that you'll be able to finalize this before the end of the year? And with everything that is going on in this market right now, what is most important to you in terms of anti-manipulation and also consumer protections in terms of really getting it on the books?
We're making fantastic progress in finalizing these rules. We received a lot of really substantive and helpful comments, both through the advance notice proposed rulemaking and the newer Rule 40.11 rulemaking proposal, and we're hoping to finalize that very soon. We're also moving forward with, we've proposed some rules on record keeping and reporting. We're hoping to finalize that, and we'll have some new rules proposed very soon.
I'm wondering what lessons you've learned when it comes to some of the more convoluted geopolitical contracts. There was a lot of talk at the beginning of the conflict related to the Ayatollah, for example. What lessons have you learned more broadly this year that you're applying going forward?
Well, when I came into the seat, Pandora's box was sort of opened, right? There were all of these novel instruments and contracts trading in our markets. You mentioned the Ayatollah contract. We've had all sorts of interesting contracts, both within our U.S. markets and offshore. So I've evaluated these contracts, and we've began to provide guidance, implement rules, and address some of these edge cases. A lot of these contracts, to the extent they involve war, terrorism, assassination, gaming, will be subject to the special rule. That means we get a special evaluation of these contracts, and they have to be able to be traded, in a way that supports the public interest. And so we're going to evaluate that. We've put out some standards and rules as to what the public interest factor should be, how we should evaluate that, because the commission is not the public, right? We're not the ones deciding what's in the public's interest. We need to put that out for notice and comment, and so that's exactly what we've done, and we're hoping to set standards around that. For all the contracts that do not involve war, terrorism, assassination, gaming, illegal acts, and therefore are subject to this special rule, we have to consider just whether they're readily susceptible to manipulation. We don't have special authority to, say, throw out a cultural event contract or something else that's not really subject to these more severe rules under our statute. So we'll evaluate the contracts. We're building a regulatory framework for these. We've heard the commenters loud and clear that they want more consumer protections for retail, and we're going to implement that as well.
In the final minute I have you, I also wanted to ask you about your opening comment when it comes to AI compute futures. Do you think that these are the right products to help lenders, but also tech companies and those in the AI industry to hedge against their costs?
If America is going to win the AI race, we have to dominate the compute markets. This is the most important commodity, I think, of our time. This is essentially a digital oil. Some have called it the gasoline of the technological revolution. We've got to have these markets here. We want the prices to be discovered for this valuable commodity in the United States, the benchmarks to be here, and we want it to trade here in markets where it's transparent, where we have kind of an open order book and all of the things that have made our markets the best in the world. So we're working very hard together with Secretary Lutnick and the Department of Commerce to set the standard here in the U.S. I don't want a bunch of, bad products trading in the U.S. We want the best of the best, and we're going to lead in these markets. And so we put out a request for comments yesterday on this issue, and we'll continue to build that regulatory framework so that we can win the AI race.
But with this much excitement, do you have a time frame for when, these exchanges can expect to be able to list these products if it does pass muster?
We've put out this request for comments. That's about, I think, a 30 to 45-day comment window. We'll take that input in. We're working together with Commerce. Expect some updates in the next couple months.
Great conversation with the chair of the CFTC, Michael Selig, along with Bloomberg's Tyler Kendall, our Washington correspondent, doing great work at this inaugural meeting of the Innovation Advisory Committee at the Commission. That'll do it here for the early edition of Balance of Power, but we'll have much more on the late edition starting at 5 p.m. Eastern time as we check back in on where the bond markets end up as yields are once again climbing today. We're up 5 basis points on the 30-year to just shy of 424, retracing a lot of the gains made yesterday off the Treasury's bigger buyback announcement. Even the Treasury Secretary Scott Bessent saying they might buy back even more, not doing it for the market as it contends with a $40 trillion debt level and climbing here in the U.S. We'll have more on that later today. In the meantime, Bloomberg Business Week Daily is right ahead here on Bloomberg TV and radio.